For over a decade, Portugal's non-habitual resident program was the gold standard for European relocation. It was a simple, broad-spectrum tax net that got everyone, from surfing digital nomads to retirees looking to protect their pensions. But as of late 2023, the message across expat forums and viral retirement videos has been one of panic. NHR is dead. While the original program has indeed been phased out for new applicants, Portugal has not abandoned its desire to attract global talent. In its place stands the incentive for scientific research and innovation, IFICI, popularly known as NHR 2.0. However, the 2.0 label is slightly misleading. It is a fundamental shift in strategy. If you're planning to move to Portugal in 2026, the rules of the game have changed, especially regarding what qualifies as income and who is invited to the party. Welcome to Taxplained, explaining taxes so you can minimize your tax burden while you maximize your freedom. The original NHR was a pull factor for almost anyone who hadn't lived in Portugal for the previous 5 years. It was an umbrella that covered retirees, passive income earners, and workers alike. NHR 2.0, FC, established through the 2024 state budget law, is a much sharper instrument. It's designed specifically to bolster the Portuguese economy through innovation, research, and the high-tech industry. To qualify for the new 10-year tax benefit, you can no longer simply show up with a foreign pension or a remote job in a generic field. The new regime is strictly activity-based. Eligibility is now tied to specific sectors: higher education, teaching, scientific research, technology and innovation centers, and highly qualified roles within certified startups or companies recognized by the Portuguese Trade and Investment Agency. If you manage to fit into one of the high-value professional categories, such as a software engineer or a medical researcher or a director in a strategic export-oriented company, the primary carrot of the program remains intact. Qualifying employment or self-employment income is taxed at a flat rate of 20%. In a country where progressive tax brackets can climb up to 48%, and even higher when solidarity surcharges are factored in, this 20% cap is a massive shield. For a professional earning 10,000 or rather 100,000 euros, the difference between the standard tax regime and the NHR 2.0 can amount to tens of thousands of euros in annual savings. This benefit, like its predecessor, lasts for a non-renewable period of 10 consecutive years. The most significant and perhaps also most painful change in NHR 2.0 is the treatment of foreign pensions. Under the old regime, foreign pensions were famously tax exempt, later adjusted to a flat 10% rate in 2020. This made Portugal a global retirement haven. Under NHR 2.0, that door has been slammed shut in your face. Foreign-sourced pensions are notably absent from the exemption list. In 2026, if you move to Portugal as a retiree under the new regime, your pension income will be subject to a standard Portuguese progressive tax rates. These rates begin at 14.5% and scale up aggressively. For many retirees, this single change shifts the financial math of moving to Portugal from a no-brainer to needs a spreadsheet. Are you considering a move to Portugal? If you have global income and want to see if NHR 2.0 is your best path forward, please reach out to our specialist team for a personalized assessment. While retirees face a tougher climb, investors and entrepreneurs may find NHR 2.0 increasingly lucrative though. One of the quiet wins in the new legislation includes foreign-sourced capital gains. In the original NHR, the tax treatment of capital gains, especially from the sale of securities like stocks, was often a grey area that required navigation of the double taxation treaty. NHR 2.0 provides a clearer and, in some cases, more generous path. Foreign-sourced capital gains like dividends, interests and rental income are generally exempt from Portuguese taxation, provided they can be taxed in the source country under a tax treaty or a treaty that is similar to the OECD Model Tax Convention. Some of the early interpretations of the IFICI regulations suggest that capital gains on the sale of foreign shares are now explicitly exempt, provided they aren't sourced from a blacklisted tax haven country. This makes the regime a gift that keeps on giving for those who live off investment portfolios partially rather than fixed income. Applying for NHR 2.0 is far more administratively rigorous than the old system. You cannot simply self-declare your high-value status. The process now involves multiple government agencies deciding, or rather depending on your sector. Residency first. You must first secure the legal right to reside in Portugal, whether through an EU passport, a D8 Digital Nomad Visa, or a Golden Visa. Tax residency also counts. You must establish your tax domicile in Portugal, which means spending more than 183 days there or having a habitual home there. You also need some certifications, as this is the new hurdle. Your employer or your specific role must be certified by an agency like the National Innovation Agency or Startup Portugal. You must prove you hold at least a bachelor's degree, level 6 in the EU, or a doctorate, level 8 in the EU, and in many cases have several years of verified experience in your field. Applications must be submitted via the Portal das Finanças by January 15th of the year following your move. Missing this window effectively forfeits your 10-year benefit completely. Another critical distinction for 2026 is the requirement for substance within Portugal. NHR 2.0 is not for the accidental expat who works for a US or UK company that has no presence in Portugal. To qualify for the 20% rate, the work must generally be performed for a Portuguese entity or a foreign entity with a permanent establishment in Portugal. For the so-called solopreneur or freelancer, this often means setting up a Portugal Limited, LDA. The company must often demonstrate its own value to the economy, for example, by having an export-oriented business model where at least 50% of turnover comes from outside of Portugal. The death of the old NHR was an ending, but NHR 2.0 is a sophisticated new beginning. Portugal has pivoted from being a destination for tax tourists to being a destination for innovation architects. If you are a tech lead, a biotech researcher or a startup founder, Portugal in 2026 is arguably more attractive than ever due to the clarity of the capital gains exemptions. If you are a retiree with significant foreign pension, the tax landscape has undeniably hardened for you. However, even without the pension exemption, Portugal remains a whitelisted EU jurisdiction with a high quality of life, excellent healthcare, and of course a cost of living that remains competitive compared to Northern Europe or North America for that matter. Although the era of easy tax residency is over, the era of strategic tax planning has begun. Navigating NHR 2.0 requires more than a flight to Lisbon. It requires a deep dive into your professional credentials and the source of every euro you earn, and it is absolutely worth it if you're ready to make the move. The transition from the old NHR to IFICI is complex and individual. If you're unsure if your profession makes the cut or how your specific investment portfolio is going to be treated, now is the time to consult with a cross-border tax specialist like those in my team to ensure your 2026 tax bill doesn't hold any unpleasant surprises.